Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on gregschnell.com as well as StockCharts.com. So the most important, or one of the most important events coming up right now is the Fed, and we have quadruple witching on Friday. So the bigger issue for us is trying to understand the nuances as the market changes. And when we look through the charts, they'll reveal things that we're not quite expecting. Like for me, I'm not expecting, or I did not think the industrial metals would go down, and yet on May the 10th, we had a big drop we had a huge surge in volume on FedEx on May the 10th. That literally marked the top, and we've been sliding since then. So the charts are giving us some clues that we can at least see them and recognize something different going on. And now we have things like the bond market starting to act up. We have the corporate bonds starting to become very interesting. The 30-year is sitting on a trend line. So the bond market's really got some odd things going on. The financials are starting to roll down a little bit. Goldman Sachs and JP Morgan were two of the worst performers last week on the Dow. Caterpillar was the worst. So with that, we're starting to see a change away from the rotation that has been the back to, or the reopening trade. So how does this set up for us going forward in the future, and what do we want to watch for from the bottom, from after the Fed? And it's not so much in the afternoon of the Fed, it's on Thursday and Friday after trading houses get time to kind of evaluate what's going on and some of the things that were said and conversations had. How does that unroll? And so today I want to cover off a few of the charts that I'm looking at and some of the things that are, I don't want to use the word surprising me, but making me continue to watch very closely as things are changing under the surface. So we have all this Fed meeting build up, and Kramer said the market could drop meaningfully based on Jay Powell screwing up question and answer period, and Paul Tudor Jones said the market is badass crazy, referring to the fact that people would rather buy a SPAC that had no business plan rather than buying an IPO of something they could actually model. So really odd situations like that. The real estate market's been exploding higher. Lumber's been almost up to $2,000 and back to $1,000 in a couple of months. So really crazy stuff. And now we've got the tech names that have been trying to climb. Yet when I flipped through them on Tuesday, all of them seem to be paused at I'll call it an important resistance level or a trend line. So we want to go through some of those. And the next big thing I think we need to keep in the back of our mind is both Texas and California are expected to run out of power this week. And we continue to push people towards electric energy. The oil companies have been shamed into not producing more. So we don't have more oil coming on stream. We don't have nearly enough electricity to meet current demand, let alone everybody moving forward. There was an article about China closing down their Bitcoin mining, and they said the biggest area that people might move to is Texas. And I'm thinking they're already in a power jam. So if all of a sudden you start spending all this power on Bitcoin mining, how is that possibly going to work out well for us? So we have lots of questions going on this week. If you're looking for more of the information that I provide, right now you can go to gregschnell.com and rather than pay $8.60, you can pay $4.97 and get the gregschnell.com/sports package. We've got Stanley Cup playoffs right now, and we've got Euro football, so lots of stuff going on in the sports world. And this weekend is also the U.S. Open for golf. So if you like what you see, consider a subscription for just right around $40 a month. Okay, let's jump into the charts. So I'm going to start with this one because I think I listened to a podcast this week, and one of the things that was interesting out of the podcast, obviously you learn something from each one, but what stood out in my mind was that the corporate debt level compared to GDP following COVID went from 65% of GDP to 74% of GDP in under a year. And that change is pretty meaningful, but the bigger implication for that is if the Fed doesn't tame inflation and all of a sudden interest rates start to rise, how many corporations wouldn't be able to afford the higher interest rates to get out of the problem that they borrowed all the money for? So this is the corporate bond market, and what we see on the bond market is basically a top made roughly around August, another attempt to break out in January, and now we've pulled down and we're sitting right here just trying to get above the 10-week moving average or the 40-week moving average. And that is a meaningful place on the chart for a couple of reasons. One is the bond market usually senses things before the stock market. And so we always talk about you'll get a recession in bonds, a recession signal out of the bond market before you get it out of the stock market. And so if that was the case, we'd have to have an inverted yield curve. We're a long way from an inverted yield curve, but here's the issue. For the corporate bond market, we actually have declining highs and declining lows in the momentum structure, and we're right around zero. So the real question is, whatever, let's say that the Fed says, no, we continue to think inflation is transitory and higher interest rates won't be a problem. You might see this bond chart break down quite meaningfully right at the zero level. And for me, I'm particularly sensitive to the PPO trend line. And when I see a downtrend and we're right around zero, it's an important place to watch for price response. So this chart to me says there's something in the air. It doesn't say something's going to happen. It just says there's something in the air. But when you look at 2018, when the PPO on this corporate bond went below zero, that was a pretty good clue. And one of the things that also happened is you went below zero. So you might remember we had the tariff talks in early 2018. This chart went down, rallied up to an August-September high and started to break down. If you go look at the stock market, it started to roll over in late September, October, and went down almost 20% into the December lows. So the bond market sniffed out a pretty weak 2018, and I think was correct. So if we just erase all the other indicators here and just put the S&P 500 on the bottom of this chart here, let's get rid of the events as well. And the idea, again, of using the bond market as a proxy, it might help us on the big picture, but it doesn't necessarily help us all the time. It's one clue out of the four pillars of assets. The bond market can be good. So here's what happened. So in 2017, everything was fine. That's what the corporate treasury said, or corporate bond said. And then it started to weaken, fall below the 40-week moving average. The stock market fell down here, rallied back up. We just barely made a higher high, and the bond market failed at the 40-week and rolled down into the December lows. It actually started to rally before the stock market bottomed, but the stock market took a meaningful hit and then fell down. Now, the corporate bond market then jumped up above the 40-week moving average, stayed above there for a long time, and that was pretty helpful. We had the brief spike down in COVID, and then we fell below here in, I'll call it that February-March timeframe, which is where the I'll call it the meme stocks or the electric vehicle stocks and all that kind of let go. And now we're rallying back up and we're sitting right around the 40-week moving average. So the question is, can we break out here again, or do we actually start to trend down? And I showed you the momentum indicator before, sitting right at zero. That's a pretty important place on the chart, and that's what we had right in here in 2018. So as we This chart can be helpful. It's not the Bible, but it's helpful to give us an idea of what we think is going on in the market. So I want to be really following the Fed here. If all of a sudden interest rates are going to push up and start to affect corporate bonds in a meaningful way, that would be a cautionary note for me. And we've got a couple of things going on. The S&P is trying to break through prior highs here, just barely above 4,200. And then we've also got the NASDAQ, which came up to its prior high. Let's just change this one. Up to its prior high this week. So we're sitting here with, I don't want to call it a triple top, but basically a left ahead and a right, and we're trying to get through this April high. If we can do that, that's fine. The real question is, does the market have the strength to just kind of handle this news from the Fed and keep going? Or have we priced it in, as Paul Tudor Jones says, or as some of the other analysts on TV have been quite vocal. Druckenmiller comes to mind about the current situation of the market and how obscure it is. And of course, when we trade it every week, we don't really use macro thought processes to check it. But one of the things I like to do on my weekly newsletter and my weekly video is go through all the charts that are meaningful. And one of the big things that's been going on lately is the NASDAQ advanced decline line hasn't been able to keep pace, and it recently tried to turn up and push higher. So as we go into this Fed meeting, I'm thinking we're actually going to be okay here and probably push right through. Now, when we look in on some of these stocks, like here's Facebook as an example, it looks nice and strong. But Facebook hadn't really done anything since the August-September highs, had been in a big downtrend, and then in March started to gently rise up. I would say it's rising, but it hasn't really been moving very fast. So the last 4 weeks, you can just see these price bars are all sitting together. So the question is, can it finally get momentum to the upside and break out? And the chart for Google or Alphabet looks the same. If it can start to push higher, perhaps that's going to work out. When we go look at other charts like Roku, which was a big climber in 2020, look at this scale over here, how compressed it got. Let's just zoom in on the last 2 years. And what you see here, the stock was roughly $100, went all the way up to $400 or $500, and it topped out around that 400 level. And now it's gently winding down, and we have a real compression where the 10-week is near the 40-week. Price can't make up its mind if it's going to be able to break out or not. And we're watching pretty closely. The PPO is right at 0. And so we want to hold that. Now, that sounds relatively benign, no big deal. But when we go look at Tesla, and just remember a couple of things, the February top and the PPO sitting around 0. When we go to Tesla, we see late January top and then sliding down. We're sitting right here with the same sort of price action on the stock relative to the moving averages, PPO sitting right at 0. And the question is, can it bounce from there? Well, maybe those two things don't really matter. Let's go to Amazon and just look at a longer time frame. And what we see when we just, pick 20 years or something, is that Amazon doesn't spend much time with its PPO below 0. And so when it does spend time down there, if we just go look in this period 04, 05, you can see basically we're in a downtrend and didn't really get anything going. Even in 06, it started to get weak. 07 and 8, we were in a big downtrend. They all look pretty small because I've got too many indicators on the chart right here. But the idea being strong stocks stay above 0. So to see Tesla sitting on the 0 line, Amazon sitting just slightly above the 0 line. I actually like the Amazon chart right here. All of those things make it more difficult to try and analyze what is going on in the market. But when we see the constant themes across these charts, so here's Peloton, again, made a high in January, pulling back down from 170 to 80, so 50% off. And now we're sitting here struggling to get back through the 200-day or caught between the 10 and the 40 week. In this case, the 10 week is below the 40 week. But we're trying to turn up here. So we're at that decision point where all of a sudden we decide whether or not the market is going to be negative and we push everything down, or whether we can start to break out to the upside. So that corporate bond chart is sitting here saying, yeah, we're in an elevated state of risk here, because if we do see interest rates or inflation rates rise and the Fed has to start controlling that by raising interest rates, then that's going to put pressure on the corporations because they borrowed so much money, and could end up saddling the corporations with less money to go towards, say, R&D, and more money has to go towards debt repayment. So interesting just to see how all the charts are lining up at this critical point. Again, that bond chart sitting at the 40-week. Amazon, Tesla, Peloton, all of them just sitting there right at the edge, trying to figure out which way we go. And I mentioned Roku earlier, but we could go through a host of other charts that were, I'll call it tech names, or even lithium names, right? Albemarle was a big one. And what we saw was we had a huge run up into the January high, pull back, and now we're trying to basically take on that January high. And the real question is, as an industrial sort of metal, is can it keep going? And let's just say it starts to roll down here, and we saw a very weak performance by copper today on Tuesday. So I'm recording this Tuesday after the close. And what we're seeing is this chart just touching the PPO. Then we've got copper, and of course we've got to make all of this electric energy because everybody's moving to electric. Well, look at the copper chart. It's breaking down below its 10-week moving average for the first time. We're breaking the uptrend in momentum. And again, when we did that on all the other charts, it was a pretty good place to be aware of the problem. So I want to keep an eye on whether or not we've actually got more growth coming, or if the Fed is right on inflation is transitory and these charts are all going to start to break down. That will be a real concern for us to pay attention to. So again, how weak could copper get? Well, I don't expect copper to get weak at all. But so I don't want to say I'm surprised it's down here. It probably could use a little bit of a break. It is trying to get through all-time highs, but this move down on Monday, Tuesday, quite frankly, pretty substantial. And what we want to see is, all of a sudden all these charts are starting to break. The commodity charts are breaking. Is it just the shortage of energy that's causing all of these charts to break, or what is it? So when we go look at the KBE, the bank index, just moving around, this one's starting to break below its 10-week moving average for the first time. So all the banks were reflation trade, or the resurging or reopening economy trade. And the PPO has long been broken on that since mid-March. The chart has gone sideways on it. No real damage done so far. When we go look at the strongest bank out there, JP Morgan, we're seeing it breaking below its 10-week. Really, there was 1 week where it closed below its 10-week in April. But the rest of the time, since November, since the reopening trade started, it stayed above this 10-week. So we're starting to see some big trends, and you can see the volume declining here. PPO uptrend is broken, and it wasn't a bad place to take profits. You were either in dead money or just kind of sitting sideways. So again, not saying everything is wrong. A lot of stuff is just starting to sit sideways, and we don't have a meaningful direction yet. Of course, we have the big dog out there, Apple, and I mean that chart's as flat as you can get. PPO touching near zero, so much like the Tesla case. And we see the moving averages. The stock is hovering between the 10-week and the 40-week. It's making new 1-month highs this week, so perhaps this is the turn. That's what we're watching for. So a lot of stuff is sort of setting up around this Fed meeting, but we don't have a clear answer. What I want to watch for now as we roll through the Fed and into June, July, because July isn't an earnings season. We have quadruple witching on Friday. As we head through over the next month, what stocks start to reemerge, and I don't want to call it the reopening trade, I want to call it the open trade, where now we're considered open. We're starting to fill the stands with fans for sporting events and concerts. Bands are going back on tour. Restaurants and patios are all full. So what is the second half trade? And we don't really have an answer for that. So we've got this meeting of the Fed mid-June. We've got another meeting early August, I think. And then we'll have a Fed meeting, or the Jackson Hole meeting in August, and roll into our September timeframe. So we've got a lot of things relying right around this current Fed meeting, as people go away for the summer and start to actually travel again. We saw the TSA record over 2 million people going through scanner systems per day, which is getting pretty high. So watching all of those things to see how it works out. Now, quite frankly, I don't know where it's going to go, but I'm watching, using the charts to try and figure out where the money's moving. And if you had followed some of the trading or some of my newsletters, and I've been giving users some access to my videos and newsletters. When FedEx made the top on the chart, this 46.10, that week was on extreme volume, and what we don't know is why it's doing that, but it definitely did it. And so what we want to watch for is, what's making the change. Well, now it was 46.10 and we're sitting here with a 36 handle. So it's dropped 25%, even though the chart doesn't look that damaged. It's those sorts of clues that we're starting to get that we need to pay attention to. And maybe it's the high cost of energy or the lack of energy. I don't really have an answer for it, but I don't like it when FedEx starts to break this down trend line. That to me is a pretty concerning situation. So I'm watching to see how the market responds to the Fed, instead of trying to guess what the Fed is actually, or what the obvious trade is going into the Fed. And I would say at this point, the only real trade that has been working well has been crude oil. And the reason I think that's pretty important, obviously, I'm from a city in Canada where we have a lot of oil company head offices, but we're seeing the PPO trying to turn up and make a higher low here. On the indicators, I'm just going to roll this out to 3 years. And this annotation, so what I would do here is I would draw an annotation line like this, much like I had on copper. And now the question is, can this continue to turn higher? I actually think it does go higher. And the reason it goes higher is because we take 100 million barrels a day of oil out of the ground. We continue to underperform on drilling. We're shaming the oil companies to not produce anymore, but we haven't brought enough electrical capacity on to handle the move to electric. So we have Bitcoin miners coming in, sucking up large volumes of electricity, and crypto miners. And then we have the move to electric cars, and everybody wants to get there so fast. I noticed the G7 on the weekend said they aren't really pushing for all vehicles, a move to electric by 2030. And I'm thinking, how much faster do you think these changes can take place, especially when they won't approve mining to get the copper and the minerals out of ground to switch people over to electric? So it's a really interesting debate. And remember, when the price of energy goes really high, don't blame the oil companies, blame the politicians, because they're the ones pushing for the price to, for the lack of resources. So if that's going to happen, one way or the other, we're going to end up paying high prices, probably for both electric and oil. Anyway, this chart continues to make higher highs. And when we look at it on a daily basis, I don't really need another copy of the crude oil chart. When we look at it on a daily basis, what we see here is the chart's been pushing up nicely. We're going to zoom in a little bit. You see this consolidation from March, April, May, and we're just breaking out now. Oops, I want to get to this one. What we see on this chart is it's literally stair-stepping higher, and we had really big drawdowns in inventory through the API report. That one's a voluntary report, whereas the EIA, Energy Information Administration, reports on Wednesdays. And so once we get that report, we'll find out what's going on. But again, we had big drawdowns. We had like a 5 million barrel drawdown in crude, I think it was. Maybe it was even 8 million. It was huge. It was after the market closed on Tuesday. But we're starting to see a dramatic pull on crude oil inventories and gasoline inventories worldwide and not being replaced. Drilling is still 60% of what it was back in 2018. So with dramatic underperformance of more drilling worldwide and the continued reopening of the economy where everybody's trying to get back to normal, we're setting ourselves up here for a real shortage of oil and a shortage of electricity. So I'm really worried about where this is all going to end up. When we go look at the solar companies, you'd think they'd be doing great. Their chart hasn't done anything in the last 60 days. And if we widen this out, what you'll see is we made our highs back in that January, February with the rest of the clean energy trade. And we've got a big downtrend going here. But where are we rolling over? Right at the 10-week moving average. And when we go to the weekly chart, guess what? We're right at the point where the 10-week and the 40-week are crossing, and we have this kind of topping structure building. And we need to figure out which way this chart is going to break. So I'm undecided as to what's going to work. We're also starting to see some of the industrial charts break down. So there's a broad picture here that just says caution. Doesn't mean get out of the market, but it does mean whatever you're in, make sure that you continue to just ride the trend you're in. And once the trend ends, don't be afraid to leave, because there are enough signs telling us to be wary of what's going on around us. Yet we've been so successful of having the market rotate from sector to sector that we haven't had a big pullback. So as we moved out of the NASDAQ and into, I'll call it the reopening trade, which had more stocks on the New York Stock Exchange, that reopening trade was relatively successful. We had the meme stocks fall hard, but for the most part, the indexes didn't fall that dramatically. All that leads up to where are we going from here? And the one thing I will say is that the technology chart has started to improve. That's one that I like. It's trying to push higher, and you can see we're testing prior highs. Let's just open this chart up a little bit more. We're testing prior highs, and then we've also got the NASDAQ when we just go zooming in here. NASDAQ 100 testing prior highs, and then we have the CompQ, the NASDAQ overall. And what we see there is that chart is testing a triple top, and so it's not clear that we have the momentum to break out. And then when we go to the S&P, our prior high was May 10th, roughly same time that we got the top in Freeport-McMoRan. And so our industrial metals have been waning since then. And you can see that we haven't had any real sort of big pushes to break out of this range. It's not like we're moving up 2%. We're just kind of eking out a gain. So for me, the real issue is as the Fed comes out here, if he announces more, I'll call it quietness towards the reopening trade and letting inflation run, I expect some more energy stocks to run and things like that, but you might find other areas of the market under pressure, and it's time to watch the results. So thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesday at 10:30 a.m. Eastern. You can also see the recordings on StockCharts TV YouTube page, as well as on StockCharts on demand. Thanks everybody for joining me. Go check out the website, gregschnell.com/sports. Thanks. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.